What's the difference between a refinance and a second mortgage?
Refinancing your mortgage or obtaining a second mortgage are two ways to increase your personal cash flow as a homeowner. However, these two options have distinct differences.
When you refinance, you replace your existing mortgage with a new one. You could do this to save money on your monthly payments by locking in a reduced interest rate. You also might be able to access a lump sum of money by refinancing for a higher amount than your current mortgage. This is known as a cash-out refinance.
With a second mortgage, you are taking out an additional home loan or a line of credit against the equity in your home. Second mortgages usually come in the form of a home equity loan or a home equity line of credit. More on that later. If this second mortgage and your primary mortgage are with different lenders, then you'll need to pay both companies separately.
Getting a second mortgage means you're taking on another lien, which comes second to that of the primary mortgage. So if your home goes into foreclosure, the primary lender will need to be satisfied first before any funds go towards paying off the second mortgage. The higher risk taken on by the secondary lender means that second mortgages typically come with higher interest rates.
It's crucial to note that whether you decide to refinance or take out a second mortgage, you won't be able to access all of the equity in your property. The amount of equity that you can access is determined by a number of factors, such as your lender, credit score, and existing debt.
What types of second mortgages exist?
Second mortgages can come in the form of a home equity loan, which is a lump sum of cash paid back over a specified period of time, or a home equity line of credit, also known as a HELOC. With a HELOC, you can borrow money up to a certain limit and within a specified time period before you start paying it back. You only take out what you need when you need it, like with a credit card.
A second mortgage is known as a piggyback mortgage, when a borrower takes out more than one mortgage to purchase a property. Why do people do this? For some, it's a way to avoid paying private mortgage insurance, also known as PMI. PMI helps protect mortgage lenders against losses if you can't repay your home loan, and is usually required if your loan exceeds 80% of the property's value. If you can't afford a 20% down payment, a piggyback mortgage can help you cover the remaining amount so that you're not required to pay PMI.
Another reason homeowners might opt for a piggyback mortgage is to avoid taking out a jumbo loan when purchasing a home with a higher price tag. Jumbo loans are mortgages that exceed the conforming loan limits for mortgages accepted by Fannie Mae and Freddie Mac. For 2021, those limits are $548,250 in most states and $822,375 in other areas with a high cost of living. Jumbo loans can have higher interest rates, so some borrowers might choose to take out a primary mortgage to finance up to the maximum conforming loan limit and then use a piggyback mortgage to cover the remaining amount.
So why might you choose to get a second mortgage instead of refinancing?
You get to keep the terms on your primary mortgage. Maybe you already have a low interest rate that you don't want to jeopardize by refinancing. When you take out a second mortgage, you're able to tap into the equity in your home without affecting your original loan's payment terms.
Also, you'll typically encounter lower closing costs when taking out a second mortgage compared to refinancing. Lenders often cover most or even all of the closing costs associated with a home equity loan, which could help you save thousands of dollars.
Another cost you may save on is the prepayment penalty. If your original mortgage has one, you can avoid paying it by taking out a second mortgage instead of refinancing.
Why might you choose to refinance instead of getting a second mortgage?
Refinancing allows you to stick with a single mortgage payment instead of making two separate payments each month. In addition, homeowners with a second mortgage face a greater risk of foreclosure if they're unable to pay their lenders on time.
Generally, cash-out refinancing also comes with lower interest rates compared to home equity loans, so you may be able to save money on interest with a refinance.
If you're deciding between refinancing and obtaining a second mortgage, we hope this information helps you make the decision that's right for you.
Thanks for watching.